I think we got some big problems in the market already, which I've been talking about. Here, you've got the XLK, the technology ETF. This is a classic topping pattern. I mean, if I were to start, if I wrote a book about a classic topping pattern, this is a chart I would show. Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. And had some interesting news out today. We had the Fed coming out with its latest policy statement. There was no change in interest rates. That's what the market was expecting. No one expected really that they would cut rates, although I believe they should have. But their wording that they used was maybe not quite as dovish as I expected, and maybe not as dovish as the overall market expected. And I'll talk about that a little bit as later as we go through the show. But what I wanted to start off here with was the actual Fed statement. So kind of zeroed in here on the PDF, showing you the actual statement and the way that they make these changes. So if you look through here, any area that has a line through it is part of the statement that was in the last policy statement, but is no longer in. And then anything that is added with an underline has been added to this meeting's policy statement that was not in the prior one. So you can see as we flip through here, there's not a whole lot that changed. It's really just in these first couple paragraphs. But I want to zero in on one line, which I think was the most important line of everything that they talked about. And that's here in the second paragraph, the last sentence, where they talk about the economic outlook is uncertain, because they said the same thing last meeting. And they went on to say, and the committee is attentive to the risks to both sides of its dual mandate. Now, think about the dual mandate. What the Fed is trying to do, and what it always tries to do, is to maximize employment and to stabilize prices. So think about maximizing employment as part of what it does to help stimulate the economy or help slow down the economy. And then stabilizing prices is when they're dealing with inflation. And so what they have done in the past, and what their main mandate has really been, is to control inflation. They've been talking about, getting inflation down to the 2% level. And we've been moving in that direction for a few years, but it hasn't been good enough for the Fed. The Fed wants to essentially almost get to 2% before they'll admit that the job is done. Well, this last sentence tells me in this meeting today, the economic outlook is uncertain, and the committee, now this is what they said last time, the committee remains highly attentive to inflation. Made no mention about, two sides of the mandate. They were only looking at inflation. So the committee remained highly attentive to inflation. This time they're saying the committee is attentive to the risks to both sides. So now they're admitting, they're talking about, hey, we see some of the uncertainty in the economy out there. We know that things maybe aren't perfect and that we're starting to see some deterioration in the economy. This is essentially the Fed saying what I've been saying all along, that we've got cracks in the economic foundation, and we are putting it on paper that we recognize it. However, we're not lowering rates. And quite honestly, they didn't come out and say they were going to lower them in September, even though pretty much everybody is assuming that the Fed's going to lower rates in September. That, they want to continue to monitor inflation. They're going to continue to monitor the data. And, but they did say that, we have made some further, and that was in the first paragraph. In recent months, there has been some further progress toward the committee's 2% inflation objective, instead of saying there has been modest further progress. So, it's a play on words, but I think, you can kind of read into some of this and say, okay, the Fed is getting closer to cutting rates, but they don't make it obvious. And they are, this has been kind of consistent. If they're consistent about one thing, it's been that they want to kind of make sure that inflation is squashed no matter what happens to the economy. And so all along, the stock market's been looking for Goldilocks. It's been looking for the soft landing that, hey, we can take care of inflation by raising rates, and the economy will remain strong enough, even with higher rates for a while anyway, that we don't have to worry about lowering it. Well, the cracks are starting to suggest you need to start lowering it, or you're going to have a problem with the economy, potentially a recession, which is what a soft landing tries to avoid. So I'm looking at this and I'm saying, okay, Fed now realizes that, hey, and even put it in writing that we see the deterioration in the economy. We're not ignoring it. We see it, but our battle is still inflation. And I'm not sure this is going to play out well over the next couple of months. We'll see. Couple of charts I want you to take a look at. First, this is the initial jobless claims. I want you to take a look back in 1999 and 2000. You see how generally when initial jobless claims are going down, stock market's going up. Initial jobless claims spike, stock market goes down. Initial jobless claims goes down, stock market goes up. Initial jobless claims spike, market goes down. Initial jobless claims trends down, stock market goes up. Then we have a breakout on initial jobless claims. Of course, this was the pandemic. Maybe this is a one-off. I'm not sure really how much we want to pay attention to this. It's really unlike any other. But initial jobless claims went up. Market got killed to the downside. And then as we started moving back down, stock market went up. Now, as we get into this whole inflation thing, I mean, the stock market went down even though we continued going lower in initial jobless claims because the stock market here wasn't so concerned with the economy. It was concerned with inflation. Remember, those are the two mandates for the Fed. Now we move back up in 2023. Initial jobless claims starts to move back up, starting to show, maybe we need to be a little concerned about the economy. We pulled back, but now here we come back up again. And if we break out to a 2-year high, it would be similar to what we did in 2019 and 2020 before the market went down significantly. It would be the same as what happened back in late 2007. Right at the market top is when we made a 2-year breakout on initial jobless claims. And go back to 1999 and 2000, when we made that 2-year breakout, that's when the market went down. It was right at the top of the market. So we're close to the top of the market. And if initial jobless claims breaks out, when I talk about some of the deterioration in the economy and the cracks in the foundation, this is kind of what I'm talking about. We're starting to see more of a move to the upside in initial jobless claims, though I would say we're not quite there yet in terms of potentially triggering a recession, but we're getting closer and closer. Watch initial jobless claims. Next, the unemployment rate. Unemployment rate goes down, stock market goes up. Once we start to move higher, once we bottom and the unemployment rate start moving up, stock market a little bit later that year started to struggle. Then unemployment rate comes down, stock market goes up. We start to turn higher in the unemployment rate. Later that year, we top and the stock market goes down. Then we have this long period of declining unemployment rate. Stock market goes up. We break it, start moving higher, market comes down. And now look at what's going on. We're seeing that unemployment rate rising. So far, we haven't had a big problem. But remember, in the past, when we started rising, the top came later. So we're starting to rise. This top could be coming. It may have already hit when we got up to the 5,600 level on the S&P 500. So watch the unemployment rate. Non-farm payrolls comes out on Friday morning. The unemployment rate was 4.1% in the prior month. It's expected to stay the same. But if we get 4.2, just telling you, listen, I'm just showing you the facts here, not my opinion. This is the facts. When the unemployment rate starts to go up, less people are working. So you got less money to be spent. That kind of makes sense. that when the employment rate's going up, initial jobless claims are going up, the economy's weakening. Even though last quarter's GDP was higher, we're now looking at a current situation, not in the rearview mirror. So some of these things could start to suggest that maybe the Q3 GDP will further weaken and maybe come in less than expected. So these are signals that tell us to be concerned now, not 3 months ago with the prior quarter's GDP. So a lot of people get that wrong. They think, and I saw an article today talking about, well, the economy's still strong because GDP was, really good. Well, what we're seeing here is really more third quarter issue, not Q2. So we haven't gotten the GDP. We don't know what the GDP is going to be for Q3. But if things start to deteriorate, the economy could struggle even further here over the next couple of months. And we could find ourselves in a recession. And if we do, in my opinion, it was the Fed failing to cut rates soon enough. I wanted to show you, this is the ADP employment report or employment change. So every month we get the ADP employment report out a couple days ahead of non-farm payrolls. Well, here's the last 5 months of the ADP employment report. So you can see with today's announcement of 122,000 workers were added to the payrolls. We've been coming down now for 5 months since we peaked in March. 4 months since then, we've come down. So talking about economic deterioration, this doesn't mean we haven't gone negative. Usually you're going to go negative, and then you're going to start to see potential recession. Haven't gone negative yet. And I haven't said the economy has fallen apart and we're going to have a recession. I'm just saying that we're starting to have more and more signs that we need to pay attention to, because if we do, you think the growth stocks have already been hit hard? You haven't seen anything yet if we have a recession coming. Here's United States non-farm payrolls. So this is what we've seen over the last 12 months. You can see back in April, it was very low. May, we jumped back up. June, we were better than expected, although we did come back down a little bit off the May level. Where's July going to come in? We're going to know Friday morning. But I don't know, it looked like we were picking up and going into the first quarter. And, we saw that the jobs had picked up. And I think that, helped us in the second quarter in terms of GDP. But we're seeing lower numbers, which could mean lower GDP in the third quarter. And let's just see where these jobs go. I just want you to be aware that, this information is out there. And if we do see further deterioration or even possibly a move, into negative territory, I want you to look at, if we go back over this 10-year period, or maybe even the max period, let's see, in 2000, beginning of 2000, jobs were at 484,000. That was March of 2000. As we went throughout the year, 279, 168, 126, minus 19,000, that hit in January 2001. That was just after the top of the market. So we come in, maybe that may not be this month, maybe it's next month, but if we do see a minus number coming in, it could be coming in right after a market top, and things could escalate like they did in 2001. How about 2007? When we started January 2007, the non-farm payrolls was 224,000. As we went throughout the year, you can see by May, 151,000. By August, minus 25,000. Stock market topped in October of 2007. So the deterioration, sometimes you can kind of see it building while the market is still strong. And that's why I grew much more bearish, just because of some of these signs that are showing slowing. And many areas like semiconductors have just gone up too fast, too much, too fast. And so I think that those are areas that certainly could be pulling back. And I called the top on semiconductors back in June, literally the day they topped. We haven't seen a high since, and they continue to spiral lower, although they had a nice bounce today. But anyway, you can see from there, we had jobs deteriorating through 2008, and things got out of control. Fed couldn't control it in time, and we had a really big decline in the S&P 500. In 2019 into early 2020, we saw jobs, around the 200. July 2019, though, there were only 90,000. So maybe a little bit of warning there. But what we're looking at now, and as I showed you on the screen earlier, we had a little bit of a boost in 2024 in that first quarter with the jobs, pretty strong. Second quarter, though, they weren't as strong. And now we're going to get our first reading, our July reading, coming up here this Friday. Watch jobs, watch non-farm payrolls, watch the ADP employment report as we move forward over these next few months. Watch the initial jobless claims. These are all signs that, can tell us in advance that we've got troubles brewing. We already know we have technical troubles. And when we look forward to the next fundamental announcement here on Friday, jobs are expected to drop from 206,000 to 180,000. There's that unemployment rate, supposed to stay flat, 4.1%. But what if it goes to 4.2? This is just subtle. I mean, we've been climbing since the threes, lower threes in terms of unemployment. So we've been slowly working our way up. Now we're up to 4.1. What happens if we get to 4.2? What about maybe 4.3, 4.5? At what point does it start to trigger more of a trickle down into our economy, other areas of the economy? So something to keep an eye on and watch. Now, technically, I think we got some big problems in the market already, which I've been talking about. Here, you've got the XLK, the technology ETF. This is a classic topping pattern. I mean, if I were to start, if I wrote a book about a classic topping pattern, this is a chart I would show. We went up into a left shoulder. Everything looks good at the left shoulder. When we first start to get to or close to a top. So the PPO is rising, new high. Action looked really good there. And then we have a pullback. We hold the 20-day moving average, which is what we expect during an uptrend. But then on the next push to the upside, first things, as we make this breakout above the prior high, volume was among the lowest that we had seen. There was not a lot of enthusiasm for this breakout, number one. Number two, we saw a bearish engulfing candle form. That is a reversing candle, and it occurred with a negative divergence in play. So you've already got signs of slowing momentum, and then you get the confirmation candle. Reversing candle, we go all the way back down. We don't just get to the prior low, we go below it. And the reason this is critical is because during uptrends, you normally see higher highs, higher lows, higher highs, higher lows, higher high, oops, lower low. So we've got a down sloping neckline showing that we couldn't hold that prior low. So now we're starting to get price confirmation, price deterioration after the warning signs were in. Then when we do break down, what happens to the volume? The volume is more than double, actually close to triple what the volume was on the breakout. The volume is accelerating big time on the breakdown of this pattern. Normally, when you rise back up, you either challenge the neckline or the moving averages, or maybe both. And so I would really watch the XLK in the 220 to about 223 area, that range. We got a little bit more upside maybe. And if you really want this market to get going back to the upside, you want to see the XLK close above 223. Till we see that, I would be very skeptical of this bounce. And in my opinion, I think we're going to hit this measurement. The measurement would be down near 205. And right now we're at 219, almost 219. That would be almost another 7% drop from where we are right now, just to get down to the initial target. Doesn't mean we stop there. This is just the initial target of this pattern. So 205, obviously, with the XLK being 32% of the S&P 500, if we were to go down to 205, it's going to put a lot of pressure on the overall market. The Dow Jones US Semiconductor Index. Here was the top that I called. I actually wrote an article, wrote the members, 21,000. We had that bearish engulfing candle. And look at the volume that came in at this point. Very bearish. I think a top was formed, never went back through it. And now we've broken down. We're now trending below the 20-day. We just got a death cross with the 20-day falling below the 50-day. The PPO is now negative. And again, any kind of a bounce up to the 20-day moving average, actually both these moving averages and recent gap resistance, which is between about 18.6 and maybe 18.9. And we closed at 18.206 today, hit a high almost at 18.3. I think we got a little bit more room to the upside. Maybe we see a gap up tomorrow, but be careful, because if we fail at these moving averages and start rolling over again, could be a pretty decent decline on that next move lower. So be watching that. NVIDIA, one of the top stocks in the semiconductor group, had a big day today. Most of it was gapping up. I have talked about how stocks are manipulated and how they trade during the day when they are being accumulated. A lot of times you'll see gap downs, morning weakness, and then afternoon buying. I went back and looked since the top here, and the majority of the selling in NVIDIA has actually taken place from about 11 o'clock in the morning on. We've actually seen gap ups during this period and selling. That's a signal to me of distribution, which means we should be expecting further weakness in NVIDIA going forward. So watch these moving averages. Let's see if we can get through. But if we can't and we start to roll back over, again, look out below. I could see NVIDIA back below $100. I could see, I think best case scenario over the next couple of months is that NVIDIA prints a low of 95. Worst case scenario, I think we could get back down close to that April low, which would be down near 75, somewhere maybe between 75 and 80. So I love NVIDIA. I think it's a great company for the long term, but you go through periods, and especially if more recession talk is out there, more uncertainty in the stock market, stocks like NVIDIA, these growth stocks, get pounded. So be careful with that one. Last thing I want to mention is on Monday, I did some videos. I wrote articles over at Stock Charts. I encouraged folks to come in because I was going to talk about a stock that I really liked for earnings, upcoming earnings. ENVX was the company, ENVX. It just looked like on the chart, returned back down to a key support level, gap support level. And of the 708 companies that are reporting earnings this week, ENVX has outperformed its peers by the most versus all the other 707 companies. This was the best company in terms of relative performance to its peers. And that, to me, usually signals good news coming out with earnings. Anyway, the latest here on ENVX, it is up 10% after hours. This is what we gave members or subscribers to our EB Digest. This is what we gave them on Monday, telling them that, hey, the upcoming earnings, this is one of the best companies out there. Looks like it's going to have a good report. We could get a nice little pop. Here it is, 10% off of that $14 support level. Actually, a little bit more than that, from $14. Let's go over to our website at earningsbeats.com. Go to Earnings Beats, both plural, earningsbeats.com. Scroll down, sign up for our EB Digest. Name, email address is all it takes. Hit that subscribe button, and you'll be good to go. We are going to send out a special EB Digest on Friday morning, talking about some of the manipulation, talking about how the market's reacting to the Fed announcement. I think you're going to want to get a copy of that. Anybody who is a EBD subscriber will get that. And again, that will be coming out on Friday morning. So make sure you check, you go to the website here and sign up. If you are on a mobile device, we are providing you a QR code on the slide. Take advantage of that. Follow that QR code to the landing page and sign up from your mobile device. But anyway, that's it. We've got an interesting couple of months coming between what the Fed is doing. I mean, even the Fed now is acknowledging economic weakness, but they're not doing anything about it. And they're going to wait another 6 weeks to consider lowering interest rates. All that's doing, folks, is just allowing any short-term weakness in our economy to just gain steam. And I think even if they do lower rates in September, I think it's going to be too late. And I think the market is probably going to sell off on that news, in addition to probably selling off over the next couple of months anyway. So anyway, I'm not the kiss of death, or I'm not I'm not the person out there that's always screaming, look out below. I tend to be very bullish most of the time, but I've recognized a lot of issues that we are coming upon here over the next couple of months. And personally, I don't like what I'm seeing. So be careful out there. Happy trading.
Hey, if you like this video, please like and subscribe to our channel. Thanks again.